So nice to see you. Thank you for joining us.
Wonderful to be here, Janet. Great to see you face to face for the first time.
Absolutely. Tobias, you have been beating the energy drum for a long time. And you had kept making over the years a statement that, eventually this is going to turn. And I think that eventually is now. Talk to us about the current state of energy markets. There are some that are quite bullish on it, some that think this might actually be a bearish situation. So much depends on the geopolitical outcome. How do you view it at the moment?
Well, I think that the really telling problem for oil has been the long drawdown since 22 when we saw oil prices peak. And then probably because of a just cyclical weakness in the economy, we've seen oil fall pretty consistently since then to the point now where what we call supply destruction, where it's not profitable for oil companies to reinvest at these levels. And so they haven't been for an extended period of time now, with the result that we're probably a little bit under supplied in terms of oil, even though there does seem to be some oil from Russia and other places that is available. But I've been saying for a while that the nature of the oil market is that oil gets cheap and then some geopolitical event comes along, and that seems to be the catalyst that spurs higher prices. And I think we've seen that catalyst now with Iran. I think that oil has spiked on that catalyst, but I don't think it's anywhere near where it can get to. If we look at historically in 2008, oil topped out at $140. And for context, we're almost half that now. And in 1982, it was higher again. So shale has been a massive advantage for the US, providing cheaper oil. But even the shale looks to be getting closer to the end of its profitable life or useful life, perhaps. And so I think that oil could very well be the story of the next decade or so. And partly that's valuation, and partly that's just a cyclical upturn in the economy.
Oil producers here in the US saying that they probably will not be able to make up any deficit that occurs as a consequence of the war. How significant is that? How reliant are we today on domestic oil production?
Well, it's very fortunate for the US that we do have a large shale, and it has been it's made us much less dependent on foreign oil than we were in the past, but we still are reliant on it. And as I said, we've underinvested for a period of years, so these spikes will lead to more investment, but it takes a long time to bring an oil field online. It takes a long time to find more oil. And it's entirely possible that we see extraordinarily high oil prices, and it's a combination of factors. It's that geopolitical risk and just underinvestment for an extended period of time.
So you like some energy names. You've shared some with us in the past. What are the names that you would identify today as good opportunities?
I've been looking at a series of names. I like the names that have been generally cash flow positive through this long nuclear winter in oil. And with management teams that have been fairly disciplined about capital allocation, I like management teams that buy back stock when the share price is low and they're generating cash flow. And a few of those, I think one of the best operators has been Devon Energy. They're in a merger at the moment, so I'm not entirely sure what the picture for them will look like post-merger, but it seems to be a little bit of a closer to a merger of equals where there's no premium being paid. So Devon Energy uh, continues to be fairly interesting. Matador Resources has been another one. Cord, APA, Magnolia, all of those I think have been quite good at staying profitable and cash flow positive through this period and doing the capital making good capital allocation decisions. I think that if we see very high oil prices, then we may go back into that sort of merger and acquisition mania that we've seen in the past. But for the moment, they've all been fairly disciplined. So I like those names.
It seems almost naive now to think about the concept of peak oil that we used to discuss maybe 10 or 15 years ago. We went not just through that conversation, but in the past 10 or 15 years, a conversation of whether oil even mattered anymore as we went through the green energy revolution. And now we're back in a situation where oil seems more important now than ever. Talk to us about what's fundamentally changed on a global level, though, with electric vehicles, with alternative energy sources. What has stuck? What hasn't? How have the dynamics of oil demand globally actually shifted over the past 15 years?
I should say that I'm a generalist investor and I have an oil concentration at the moment because oil has been particularly low. But I've been a generalist investor in oil for about the last year. And so my impression is that I've seen peak oil as an investor at least two times in my life, 20 years ago and 10 years ago. And I think that the peak oil narrative, at some point, it's probably going to be true, but not yet. And the thing that is driving it is we're much more efficient in our use of oil in the economy to produce a dollar of economic growth or a dollar of energy, where we're still reliant on oil for most cars are still internal combustion, and it's in every other aspect of the economy. It's used in plastics and many, many other facets. So it's extraordinarily difficult to take oil out, and it'll be a very painful transition. How we achieve that is sort of a little bit above my pay grade, but it's going to be some combination of probably nuclear and some renewables. But for the moment, the runway for oil is long, and I think that we've seen demand growing out to 2050 on some of the publications that I've seen. So it's certainly not a near-term event. What tends to drive investment in oil are these spikes, these catalysts for geopolitical catalysts push the oil price higher. That creates more investment. I think we're having to do increasingly heroic things to find oil, go offshore and go very, very deep. And the oil sands seem to be plateauing a little bit. I saw ConocoPhillips is looking to sell one of their Permian oil fields for about $2 billion. So that's not a good sign when the majors are pulling out. So I think that the picture for oil is demand continue to grow, supply is becoming increasingly difficult to identify. But for the short term, it's really going to be it's a geopolitical event like Iran that spikes it and prices go up, and I think that the equities will follow.
So equities, of course, taking a beating this week as a consequence. You've been tracking the Schiller PE for a long time, telling us how unusually expensive the markets are. Your projection is they're going to get more expensive still.
Well, I don't know if we get more expensive still. At some point, I look at a combination of factors. The Schiller PE, none of these factors are perfect on their own. The Schiller PE I like because it's a cyclically adjusted, inflation adjusted measure of the price earnings. And the reason that it's important, in 2008, the bank earnings were so bad that they dragged down the earnings for the entire index, and it looked like an infinite PE when in retrospect that was a pretty good time to buy. It was a cheap time. So the single year PE was useless. But the Schiller PE showed about an average PE in 2008, 2009. But there are other measures you can look at. Just a simple series, the series to its own trend line, or you could look at Tobin's Q, which is replacement value of assets versus the market value of those assets. Or there are lots of other measures, and they all seem to work together in concert fairly well, looking at different aspects of assets or flows, or even just the Buffett indicator, which is the size of GDP versus total market capitalization. They all give roughly the same answer. And what they're saying is that we're three standard deviations above the long-term average valuation. So to put that in context, that's like 99.7% in a normal distribution. Now, stock prices aren't